Good afternoon, and welcome to the Voice of Wisdom. With over 60 years of experience as an investment banker, entrepreneur, venture capitalist, securities analyst, and advisor, Morty Davis is a Wall Street legend. In addition, Mr. Davis is an outstanding economist and highly articulate, incisive, and very entertaining political analyst and strategist. He's Wall Street and capitalism personified. The over 400 companies for which he has raised more than $3 billion over the years have created a countless number of jobs and exciting new products. Through the Voice of Wisdom, Mr. Davis explores, analyzes, and debates the most topical economic and social issues facing our world today. Joining Mr. Davis today is Mr. Haren Bhakta. He is a financial advisor and entrepreneur. Mr. Bhakta is the founder and CEO of the Inside Ownership Index, the first index fund designed to track the performance of companies with meaningful insider ownership. And now, Mr. Davis and Mr. Bhakta.
Welcome back. It's good to be with you again. Every Wednesday, 6:30. You're my favorite people in the world next to my immediate family and all my loved ones, my closest friends and neighbors, etc. And I'm delighted and excited that we have this terrific guest tonight with us, Haren Bhakta. He's out of my industry, same kind of career pursuit that I followed, and hopefully he'll be even bigger and more influential and world-changing for the better than I have been. So without further ado, let me get on with the exciting podcast tonight. As I always mention, it doesn't mean to be, but it has to be inevitably somewhat depressing with the news of the week. Always bad news as news. Breaking news, headline news is news. That's why I have this book, because it depresses me when I heard those stories, and it's likely to depress you. So the way to deal with this is get a copy of this book right away. Run out. It'll change your life. It'll be the best, smartest, and most helpful book you've ever. It's the best investment you could ever make in making your life better. So run out and get a copy right away. Okay, I'm delighted that we have a super guest tonight, an outstanding Wall Street person named Haren Bhakta. It rhymes with doctor, Haren Bhakta. He's a doctor of Wall Street. He knows how to make money in the stock markets, and he's agreed to be with us tonight and share his wisdom. So without further ado, let me introduce Haren Bhakta. Haren, it's a pleasure to have you on. Thank you so much for joining us tonight on this podcast. I can't wait. I'm excited and inspired by your willingness to be on this program and get your story to the world.
Yeah, thank you, Morty. Thank you for having me on.
Thank you for joining us. And as I said, Haren Bhakta rhymes with doctor, and he's really a doctor of all finance, a genius of finance. And let's move on and get his wisdom. So, Haren, first, before we get into the markets, tell us your story. What shaped your path into investing, finance, and ultimately building inside ownership?
Sure. Well, my father gave me a little bit of money when I was 18 to trade in the stock market in the late 90s. And I fell in love with stocks at that time. And I lost all my money when the dot-com burst, as most people did. You know, I thought I was smart at 18 and figured out I wasn't. I see similarities between now and then in terms of how the market is operating. But in 2010, I joined Merrill Lynch to manage portfolios for high net worth individuals, and I built up a practice there. Moved on to Morgan Stanley for 5.5 years. In 2017, I launched my own private practice, my own RIA. And in 2024, about 2 years ago, I launched the Inside Ownership Index, the first index fund that tracks companies with meaningful alignment or meaningful ownership amongst the leaders, bringing alignment to passive shareholders. And I created an index based on that. And the ETF that tracks this index went live last week, in fact, with the ticker symbol OWN, OWN. And yeah, I'm just very excited to get that word out there. So you know, people who invest in ETFs and index funds have another option of investing in a basket of stocks where the leadership own significant parts of the company, and you know, therefore treat their companies better.
I got you. For listeners who are not Wall Street people, what does inside ownership mean, and why do you believe it matters so much when founders, executives, or insiders have real skin in the game when they're buying their own shares in the public market?
Absolutely. I believe that, you know, Charlie Munger said, show me the incentive and I'll show you the result. And that, I think, drives home in that when a leader of an organization owns a meaningful stake, and when they make wrong decisions, they suffer the consequences personally in their net worth, they will treat the organization better, and they will go to sleep and wake up thinking about the company. And what we found is when executives own meaningful stakes in the companies they run, the companies themselves perform better. And it makes perfect sense. I mean, you know, if you're a hired manager who doesn't own any company stock, you're going to have different motivations. You're going to take different risks. When you have your own capital in the company and you're exposed to loss, you're going to just treat that company so much better. It puts investors and the leaders on the same side of the table.
And these owners who are already the major owners of the company and decide to buy even more shares in their own company.
No, it's actually the reverse. I'll explain. Most the companies in our index are founder-led. They don't have to be founder-led, but founders own significant parts of the company already because of their original creators of the company. And most of the time, these individuals are selling. So Jeff Bezos has been selling Amazon for 20 years. Jensen has been selling NVIDIA for 20 years. We don't look at the activity, the buying or selling by the insiders. What we look at is the ownership, is how much they own. And if they own significant parts of the company, that's what we track is the ownership, less so the activity. Now, if an executive owns very little stock in a company and they're buying, that will, once it reaches a certain threshold, it'll hit our index where we'll begin tracking that index. But it's very hard for just a normal hired CEO to get significant ownership in a company just by buying. They either have to be a founder, or they have to have been there quite some time and had some success and built up ownership in that way. So it's a little bit difficult for a company to reach our index when you hire a new CEO who doesn't own anything. They're not going to be able to accumulate enough shares for it to be meaningful.
But if those people in critical leadership decide to buy more shares,
It'll help.
presumably,
It'll help. But
presumably
we take the top 100 from the S&P 500 based on ownership. So, we're talking about hundreds of billions of dollars in market cap on the low end. So for a CEO to get meaningful ownership of one of these companies, a new CEO to get meaningful ownership, they're going to have to buy several $billion worth, or at least $1 billion worth, for it to be meaningful. So it's very difficult for that to happen. So,
no, but if they already have a bigger position, as you say,
and they're
they
buying, then that
they were
position is going to
founders
grow.
or
Yeah,
hired early on and gotten a bonus of a lot of shares to join. And if
absolutely.
they,
Yeah,
who presumably know the most of what's going on in their companies,
exactly.
and they would take their savings and more of their money and buy more of their shares, I can't think of a greater indication
Absolutely, and
of a reason.
that's when our index will capture more of that company, is when insiders are growing their relative ownership of the company. It's going to impact our index, and we're going to proportionally allocate more to those companies based on that ownership. So to clarify, inside ownership means the C-suite and the board. And I like to compare a hired CEO with a zoo animal and an owner operator as a wild animal. Now, a zoo animal gets fed every day, whether it successfully hunts or not. And, they have their quarterly bonus, they have their base salary, and very often a golden parachute. So a wild animal now, a owner operator, if they don't successfully hunt, they feel the pain, they starve. And that is the difference between investing in companies where executives don't own any meaningful stake, and then investing in owner operators where they feel the pain of their own mistakes, and they very often perform better. On balance, they perform better. So our index goes back 20 years, and you can see what result you would have gotten investing in owner operators. It outperformed the S&P
Really?
by 300%.
Wow.
Over that 20-year period. So the S&P earned about 600% cumulatively from
Wow.
2005 to 2025. And in the inside ownership methodology, you would have earned over 900% during
Wow.
that time period. So
That's
I
fantastic.
think, yeah, you could go back 100 years and look at all the best performing stocks over that period, all the most dominant companies, and they all originated by founders. Even today, if you look at once SpaceX, Anthropic, and OpenAI become public, you're going to see the top 10 companies in the S&P all founded, within my lifetime. And then you go to Europe, where they experienced no growth and no innovation. You look at the top 10 companies in Europe, and they were founded in 1920s. And this is the point, that it takes ownership to drive meaningful innovation. And in a world of disruption, Matt Ridley wrote a fantastic book called How Innovation Works. And innovation really works through trial and error and feedback.
Who wrote that book?
Matt Ridley.
Uh-huh.
Yeah, How Innovation Works. And he talks about how, in order for innovation to work, the people making decisions need to feel the pain, feel the mistakes immediately, and because it's through trial and error. That's why you see companies like Tesla with Elon Musk innovating, you know, 10 times faster than other companies in the same industry who had all the competitive advantages to be the one to create the electric car, yet it was Elon Musk who did, because he's close to the problem. He feels the pain of mistakes early on. When you have companies like Ford and GM, you have 18 layers between the engineers working on the problem and those making the decisions. This is why they have all the access to Tesla patents. Um, Elon Musk has made those available, open source patents, and yet all these companies with all that knowledge available to them still cannot do it. It's because of all the layers of management, and every layer lies slightly to the one above it. So by the time a bad idea is filtered up through the chain to the decision makers, it all sounds like a great idea. And this is the problem that the inside ownership solves. We invest in companies with meaningful ownership where the leaders are feeling those mistakes earlier on and innovating more rapidly. The best example I have is Intel and NVIDIA. So in July of 2020, NVIDIA and Intel were exactly the same size. They were both $250 billion chip manufacturers, or chip designers, I should say. And Intel at that moment had 7 times the revenue of NVIDIA, 7 times the profits, a higher return on equity. And you fast forward 6 years, Intel is up maybe 100% at best. NVIDIA is up more than 2,000%.
Holy
Pretty
mackerel.
enormous wealth for investors.
Amazing. Yeah.
And if you're a value investor, you would have looked at Intel as the buy. But NVIDIA had something Intel didn't. They had a wild lion as a CEO, while Intel had a zoo animal. And when you have a wild lion that goes to sleep and wakes up thinking about their company, you're going to get that innovation. So most investors, are overlooking at current figures, current fundamentals, when stock prices more so reflect future economics. And in order to analyze future economics, I think you have to pay so much more attention to leadership and how much they own, and how much past success they had, and how they allocated capital. And these are the things that we should be paying attention to, and less so about last year's earnings.
That's brilliant. Good insight. The U.S. stock market is still near all-time highs, despite the fact we're at war in Iran, tariffs are looming, slower job growth, and uncertainty around the Fed rate cuts.
Well, it will catch up eventually. I don't know when that is. AI is creating enormous value right now. It's a little bit different from 1999 or the late 90s. These companies are using operating income to spend all this money on CapEx. So it's quite different from that era when they were mostly borrowing money to spend that money. So you have these highly profitable companies investing significant money, CapEx in AI infrastructure, and the benefits to society are enormous. We're going to get extremely efficient companies and extremely efficient individuals. I'm a 3-person company myself, and I'm leveraging AI, and I'm able to do far more now than I've ever been able to do before, far more. And that gap between what I was able to do a couple years ago and now is that gap has widened so far, more so than any other technology available to anybody in the past. And the speed at which these improvements are taking place is just so enormous. So I'm not quite sure when the bubble, or if there is a bubble, will burst, but we will get a reckoning, because we are at all-time highs. And when I say all-time highs, I don't just mean the price. We're always going to make new highs eventually, but I mean relative price for the earnings that we're paying for now on a cyclical adjusted basis. I think we're at a Schiller PE of 40 or near there. I mean, that's all-time highs, and I don't know how sustainable that is. One thing that's quite crazy is that we've had an earnings multiple contraction. We've had earnings go up faster than the stock market went up, surprisingly. So it's pretty crazy. So even though we're at all-time highs, earnings have been going up. And it's funny because the earnings haven't been in aggregate. The earnings are really concentrated amongst the very few. And I don't see that changing. AI is going to create even more disparity between the average company and the
Right.
extreme winners. We're in a digital world now that's infinitely scalable. So companies who are the best at something can now do that something for everybody in the planet, versus before. If you're good at something, you might get a lot of market share, but you're not going to be able to do it for the entire world. But now that has changed. If you're the best marketplace online, now you could sell your products to the whole world through that marketplace, right? That never existed before. So we're gonna just get more or fewer dominant companies, but those companies are gonna be more dominant than in the past.
That's true. AI stocks have outperformed the market by multiples. If you invested in
Absolutely. And
AI
that's probably
over a
not
year
gonna
ago,
change.
you've made a fortune.
Yeah, and that's not gonna change. We're gonna get some extreme winners. Extreme. We're gonna get 100 trillion. I think we're gonna get to $100 trillion faster than what we got between, call it a billion to 100 billion. The first $1 billion company, um, I'm not quite sure when that was. I believe it was in the 30s or 40s, but the time it took to go from 1 billion to 100 billion probably took a couple of decades. Um, I think we'll go from 1 trillion to 100 trillion much more rapidly, and that's because we're gonna get those the small number of extreme winners that really are able to capture uh, um, the monopolies. Basically, they're able to do what they're good at for the whole planet. Versus before, if you're good at something, you might um, dominate the United States, but now these companies could dominate the whole world. I think that we will eventually have a correction. I'm not quite sure when that is. I I I personally think I think it might be 1998 right now. In a similar, it kind of reminds me of 1998, where the value created from AI is still rapidly growing in the way that the internet was working in 1998. We saw a wide range of users of the internet, and we still saw productivity gains all through 1998. By the year 2000, I think the whole planet at that time was probably not the whole planet, but at least the whole United States was using the internet by then. And I think in a similar way, we're not seeing everybody using AI yet. Now, many and most people are, but it's not everybody. So once we get mass adoption between AI, I think that's when we can get that burst of the bubble.
Where do you see value in today's market? Are there sectors, types of companies, or investment themes that look especially attractive to you right now?
Yeah, well, I'm not a stock picker. You know, I created an index fund specifically for people who don't have the time or simply don't know how to pick stocks. Now, I used to enjoy picking stocks, but I'll be honest with you, I have underperformed my own index. So I no longer pick stocks. I have no need to. I'm outperforming, 95% of investors simply investing in a passive index fund. But I think academia, which has been very supportive of index funds, got it half correct. Now they're right; we should be indexing, but what they got half correct or half wrong is that we should be indexing to leaders and not the individual corporations themselves. So I ask a thought experiment, and you have a very successful organization run by very successful leaders who innovated new products and innovations. And I ask you, if we replace those leaders with entirely new people, is that corporation the same? And most people will say no. It's not the same company, even though they have the same name on the wall, same patents. But all a corporation is a group of people. And if we replace those people with new people, it's not the same company. And the S&P 500 will treat that company exactly the same. The inside ownership index would treat that company differently because the
Would
ownership
you,
would be different.
Haren, would you tell our listeners what you see value in today's market?
Well, I see value in owner operators. I would invest in owner operators. I would pay less attention to last year's earnings. I would formulate a philosophy on developing a view on the future earnings based on leadership, what the leadership has done in the
Right.
past, what type of moat the company has, and will that leader be able to adapt as the world changes? What kind of plan does the company have? If a company has a 5-year plan, I would probably not invest in that company because it, you don't want leadership to be locked in a certain point of view. Imagine you're a retail store and you have 100 locations, and your 5-year plan is to have 1,000 in 5 years, and then the internet comes along, and it's no longer necessary to have 1,000 stores. You're better off, in fact, having maybe 50 stores. So, Warren
Haren,
Buffett talks a lot about how they have no business plan, they have no mission statement. And Nvidia and some of these other companies, Tesla, they're exactly the same way. There's no business plan. They simply adapt to the way the world is changing, and those are the type of companies you want to invest in. Again, I would focus on the owner operators all across different sectors. So one thing I'll note is that certain industries do not have many owner operators. So, for example, communications, where Verizon and AT&T have been the dominant leaders for 100 years. They've also had very low returns on capital and haven't innovated at all. And then you got like in other industries like energy, where Chevron and Exxon have been the leaders for 100 years. They've also not innovated and also had very low returns on invested capital. So I would again focus on the industries where leadership owns meaningful stakes, and you'll see much more innovation there. And if you're going to play in the energy or communications industries, I would again look for the owner operators. And those companies will be smaller.
Crypto has gone from boom to bust to boom again. Is crypto a real asset class, a useful technology, or is it another version of the tulip craze?
To be honest, I don't know, but I'll say one thing. I'll say a couple things. I don't own any crypto. I don't own any Bitcoin. But I will add that crypto or Bitcoin has not been tested yet through a liquidity crisis. We haven't had a liquidity crisis since 2020. I'm sorry, we haven't had a liquidity crisis since 2008. 2020 was not a liquidity crisis. It was COVID-19. But we don't know how Bitcoin will hold up in an actual liquidity crisis. So we had one in 2008. I think we had another one in the early 90s, in the 70s. So until Bitcoin can survive a true liquidity crisis, I'm hesitant to really put any significant money in, or recommend putting significant money into Bitcoin.
I got you. Artificial intelligence, AI, has been one of the biggest drivers of the markets, going faster than any other sector. Is AI another useful technology, or is it another version of the tulip craze?
For AI, no, AI is absolutely valuable. AI is doing amazing things. Again, I'm able to do so much with so little. I'm creating videos, content, writing newsletters.
So you think the excitement and the run up and the shares of AI, artificial intelligence, is a true economic revolution, or are investors getting caught in another bubble?
I think it's both. I think it's both. Now, I
It's
don't know how
both.
far. No, we investors are paying a very high premium for exposure to these companies at this point. Whether those companies will produce the profits that they're hoping for based on the prices they're paying is to be seen. But again, there will be some extreme winners. To give an example, people who looked at Tesla from 2015 till 2021, you know, when they looked at the current figures, it didn't make sense. You know, at some point, I remember in 2020, Tesla was valued at $1 million per car they sold, and value investors couldn't wrap their head around it. But Tesla was never valued at what they were currently doing. They were valued at future expectations, and those future expectations held true, right? So, you know, we'll see what SpaceX does. Now, SpaceX is already valued at almost $2 trillion, but they have an extreme advantage, and there's not even a close competitor to what SpaceX can do. Elon Musk took the whole entire cost structure of launching a rocket, reusing a rocket, and using first principles has brought that down to a fraction of what it used to cost to launch a rocket. And this is a problem. You hire a manager to run a rocket company, and they think completely in the box. And Elon Musk comes around. For 100 years, a rocket went up in the air and landed in the ocean. No one had thought to reuse the rocket. And Elon Musk comes around and says, "Well, why don't we just land these rockets on their butt and reuse them?" And it's just so crazy that people like Elon and Mark Zuckerberg and Jeff Bezos can create these extremely valuable companies by just thinking completely outside the box. Who would have
Haren,
thought we could order something and have it on our doorstep the same day or next day at no cost? We're paying essentially no cost in shipping and handling. And if you ask someone that 20 years ago, they would have said it's impossible. And here we are.
Haren, I don't want to rush you through any of your answers because they're so incisive and so useful for our listeners. But I want to get off in another direction. Is
Sure.
China a serious threat to the United States and the global order, or is this fear greatly exaggerated?
Well, I think China is a rational country. I think that to have a strong U.S., having a strong China is beneficial.
Is what?
I think it's beneficial to have
Both.
both be strong countries.
Good.
And I don't think us being strong or them being strong is at each other's expense. I think we could all be strong nations. And I do
Right.
believe China thinks rationally, and they're not going to do anything to jeopardize, geopolitics. I'm very much in the belief of what Charlie Munger has talked about, and he saw great things coming out of China and the speed at which their economic development has taken place over the last 20, 30 years is amazing. So I think China will do amazing things, and I think so will we.
Haren, you're great, and we're running out of time, so I want to give you the last question. For the average investor investing today, what are the biggest mistakes to avoid, and what is the single most important principle for building wealth over the next 5 or 10 years?
I think the single biggest mistake investors make is timing the market. Now, it's not timing the market, it's time in the market. What we want to do is have our money working for us in the market for a very long time. And too many people are afraid to put money in the market, and they go in and out, or they put too much in at once. So what I recommend is what's called dollar cost averaging. So you slowly accumulate market exposure by regularly buying every month, and really just holding, and do your best to not care about short-term results. And over a long enough period of time, you're gonna be extremely wealthy.
That's great advice.
Well, Warren Buffett talked a lot about if you bought one share of Coca-Cola when it went public, I think it was like 1919, around there, early 1900s, and it was $40 a share. I think it was 1911 actually. It was $40 a share, and the next year it went down more than 50%. That $40 share was $19, so you lost more than half your money. But
Which
that one
company?
$40 share would now be
Which
more than
company was that?
Coca-Cola.
Oh,
And that one $40 share of Coca-Cola would now be more than $10 million with reinvested.
that's amazing.
Yeah, and if you had perfect foresight, you would have saw a World War I coming. You would have saw a World War II coming. You would have saw massive inflation, and you would have paid attention to the wrong things. The only thing that mattered was that more people are going to be drinking Coca-Cola, 10, 20 years from now, and it's going to make more and more people happy
Yeah.
as
My
time
big
goes on.
My big mistake was buying the drink instead of the stock.
Exactly.
Anyway, thank you so much for your wisdom. You were great. If any of our listeners want to get in touch with you, are you reachable by phone or anything?
Yes, I have a website, insideownership.com. Very easy, insideownership.com. They can reach me. The ETF that we created is OWN, own. And it's again a passive index fund that invests in owner operators, the top 100 from the S&P 500. And I'd encourage your listeners to go check it out.
Okay, that's a special tip from one of the great guys on Wall Street. Thank you, Haren. You were great. God bless
Thank you.
And God bless you all. Thanks for being with me again this Wednesday at 6:30, and I look forward to being with you again this same time, same station, 6:30 next Wednesday. God bless you. I love you, and I wish you and all your loved ones everything wonderful in the ensuing week and all the ensuing years. Goodbye.